As of 12 p.m. Eastern Time on November 6, 2025, BigBear.ai, ticker BBAI, is trading at $5.66 per share. That is a sharp drop, down 49 cents on the day, a loss of nearly 8% in just the first few hours of trading. This is not a quiet session. The stock is moving on heavy volume, with over 24 million shares already changing hands, smashing its typical average. The stock gapped down at the open to $6.06 from yesterday's close of $6.15, and has been sliding since, hitting a low of $5.61. This is the kind of price action that stops you in your tracks, especially because the general story around this company has been one of ambitious growth, big government contracts, and a future tied to the national security AI sector. Seeing it bleed out 8% on a random Thursday forces us to ask what the market knows, or fears, that isn't making the headlines. The popular expectation for BBAI has been, for a long time, that it's the next great AI defense stock, a smaller, more nimble version of Palantir. Investors see the name BigBear.ai and they picture a high-growth, high-margin software company selling a scalable platform to every three-letter agency in Washington. The narrative is fueled by major contract announcements, like its work with the U.S. Air Force and its expansion into biometric security with its Veriscan technology. This is the story that has propelled the stock over 280% in the last year and created a loyal following on forums like Reddit and X, where you'll find price targets of $10, $12, and beyond. The expectation is clear. This is a rocket ship. But the reality of today's price action and the financials beneath it tells a very different, very complicated, and frankly, a much more dangerous story. The reality is that BBAI may not be the company that many investors think it is. Let's dig into this tension. The primary conflict here isn't just bulls versus bears, it's high-margin software versus low-margin consulting. While investors are pricing BBAI like a software-as-a-service company, its financials look a lot more like a government contractor, a consulting firm that builds specific things for one client. The difference is critical. A software company builds one platform and sells it 1,000 times, leading to gross margins in the 70, 80, or even 90% range. A consulting firm builds a specific thing for one client, which is labor-intensive and has much lower margins. BigBear.ai's gross margins have been hovering in the 20 to 30% range. That is a massive disconnect from the software-level valuation it sometimes receives. This isn't a small detail. It is the entire foundation of the bear case against the stock. And that bear case is getting louder. The company's second quarter earnings report from August was, to put it mildly, a shock for the growth narrative. Revenue didn't grow. It fell 18% year over year to $32.5 million, which was blamed on lower volume from certain U.S. Army programs. This is the exact opposite of what you want to see from a supposed hyper-growth AI story. The net loss was a staggering $228.6 million. Now, to be fair, a huge chunk of that, over $200 million, was from non-cash charges related to derivative liabilities and a goodwill impairment. But even the adjusted EBITDA was a loss of $8.5 million. The company is burning cash, and its core business is shrinking, not growing. This is the reality that is crashing against the market's expectations. This brings us to today's heavy selling. All eyes are now on the company's third quarter earnings report, which is scheduled for release after the bell on November 10th, just a few days from now. The consensus analyst expectation is for another revenue decline, projecting around $31.1 million, which would be a 25% drop from the same period last year. They are also expecting another loss per share. Today's 8% drop on massive volume looks a lot like big money investors getting out before that report, fearing that the numbers will confirm the bear thesis and that the downward trend in revenue is not a blip, but a pattern. The high volume suggests this isn't just retail traders panic selling. This is institutional rotation. We can see this in the 13F filings. While some funds like IMC Chicago have added to their positions, other major holders have been selling out completely. There is no strong consensus here, just a battlefield. Now we have to talk about the elephant in the room, the short interest. This stock is, and has been, a massive target for short sellers. According to the most recent official data from mid-October, 76.75 million shares of BBAI were sold short. That translates to just under 18% of the company's entire free-floating stock. This is an extremely high number, and it confirms that a significant portion of the market is betting heavily that the price will fall. Their thesis is exactly what we just discussed. This is an unprofitable, low-margin, revenue-shrinking consulting firm that is masquerading as a high-growth AI software company. They look at its price-to-sales ratio, see it's at a premium, and they smell blood. On forums, you see this tension playing out in real time. Retail bulls talk about hedge funds manipulating the stock, while bears point directly to the balance sheet. What's your take on this? Do you think the high short interest is a sign of smart money sniffing out a major overvaluation, or is it a coordinated attack on a company with real potential? Let me know in the comments. For investors, it is critical to understand how this works. You can find short interest data on most financial platforms, and it's usually updated twice a month. But the percentage of float is only half the story. The other, more important metric is the short ratio, or days to cover. This tells you how many days it would take for all the shorts to buy back their shares based on the average daily trading volume. In BBAI's case, the days to cover is only 0.8. That is incredibly low. Because the stock trades with such high volume, all 76 million shorted shares could theoretically be covered in less than one full trading day. This is not the trapped short scenario you see in squeeze legends. The shorts here are not trapped. They have ample liquidity to get in and out. This means that while the high short interest can add fuel to a rally on good news, it also means the shorts can exit their positions quickly without causing a massive uncontrolled squeeze. Chasing a squeeze in a stock with this much liquidity and a fundamental reason for the short seller's presence is exceptionally risky. You should also watch the borrow fee rate. If that rate, the interest shorts have to pay to borrow shares, starts to spike, it can indicate that shares are becoming scarce and pressure is building. So, who is BigBear.ai? What does the company actually do? It was founded to provide AI-powered decision intelligence, primarily for the U.S. government. Its clients are in national security, defense, and homeland security. It helps them analyze massive, complex data sets to make faster, better decisions. Think predictive analytics for military logistics or identifying threats at a border. This is why its work with the Army on their Global Force Information Management System was such a cornerstone contract. The company recently expanded by acquiring Pangiam, pushing it into the biometric identity market, which is where its VeriScan face recognition technology comes into play. This is a legitimate, serious business focused on critical government needs. The problem isn't that the company is a fraud. The problem is that its business model is tough, competitive, and low margin. It's competing directly against giants like Leidos and Palantir, and it simply does not have the scalable, high-margin software platform that investors have fallen in love with. This all leads to the future outlook, which is balanced on a knife's edge and hinges entirely on that expectation versus reality framework. The bull case scenario is that the market has it all wrong. The bull case is that the $390.8 million in cash the company had at the end of Q2 will be used to successfully pivot. Maybe they use it to develop a truly scalable commercial AI platform. Maybe the Pangium acquisition opens up a brand new high-growth commercial market. In this scenario, the earnings report on November 10th shows that the revenue decline has bottomed out. Maybe they announce a new unexpected contract or a strong outlook for 2026. If that happens, the 18% short interest will act as rocket fuel, and the stock could violently reverse today's losses. The bear case scenario is that reality bites. The earnings report on Monday confirms the trend. Revenue is down again, losses continue, and the core business is stagnating. In this scenario, the company is just a low-margin government contractor, and the current valuation is far too high. The stock will continue to bleed out as the market adjusts its expectations from AI rocket ship to defense consulting firm. The central question remains: can BigBear.ai become the company investors already believe it is?